Welcome back. You're watching Your World at 10. Lots of action on Capitol Hill in Washington today. The Goldman Sachs management has been grilled by the Senate committee about its role in the financial crisis of 2008 and on the recent case filed by the SEC. Meanwhile, Senate Banking Committee head Chris Dodd is trying to move another vote on the financial regulation bill. CNBC's Maria Bartiromo spoke to noted banking analyst Meredith Whitney on the Goldman Sachs case and how the Dodd Bill will reshape Wall Street. Here's an excerpt of that conversation.
Let's talk about financial reform. What do you think is going to come out into law based on what we know already to be in the Dodd Bill? And how does that change the industry? Are you expecting this industry to go through real change in the coming couple of years?
The Dodd Bill wall, I'd call it squishy. So it sends a lot of things back to the regulators. So it doesn't actually enact anything. It doesn't actually enact the vocal rule. It just gives a lot more authority to the regulatory bodies to then decide on specific cases what makes sense, what doesn't make sense. What I expect to change on a continued basis is the big banks to continue to de-risk and the big banks to get more regulatory scrutiny over the businesses that have actually carried them out of this financial crisis. So that's the capital markets business. What hasn't changed and what really needs to change is the banks' pricing on basic businesses. So the large banks that control all the major loan products, the credit card market, the mortgage market, have forgotten how to price these products. And so they've moved away from that market. So you see nothing in the mortgage market and nothing in the credit card market actually expand for consumers. Those two markets are contracting dramatically. And that's because of the basic issue that the banks have forgotten how to price accurately for them. And with the Card Act, it is more prohibitive for them to dynamically price these issues. So what it ends up leaving these business models is a capital markets business and a processing business.
So how do you think we'll see the business change? In other words, are we going to see asset sales, do you think, as a result of the financial reform? You say there's going to be less leverage, obviously, yeah. De-risking. So are we talking about smaller balance sheets?
You're going to have smaller balance sheets. Now, for the guys that adapt the fastest, I think that's a good thing because higher capital, lower returns. But for the guys that don't adapt, I expect those business models to be at risk of atrophying because, of course, if you can't price for risk and if you're not making loans to the riskier, who are you making loans to? Pretty much old people, right? So your business model runs risk of atrophying. This is on the pure lending side. On the other side, other things that have to change are, you're moving away from expansion of credit across all different class lines, and it's really a class line issue, to now a debanking of the industry. So I think the middle class steadily gets debanked, moving out of the banking system and moving on to what is emerging rapidly as this prepaid business. So curiously, like Japan, when Japan had their banking crisis, the banks moved away from lending and predatory lenders moved to fill the void. You're starting to see that.
It created a whole new problem, actually.
Right.
Let me get your take on some specifics here. Goldman Sachs, as an investor, what are your thoughts on the fraud charges?
It's hard to know specifically on fraud, and I'm not the first to say this, but who would have ever thought Goldman? I remember last Saturday waking up and seeing across every headline Goldman and fraud. And that damage, sadly, is done, whether they're guilty or they're not guilty. It gives a lot of the governments, particularly European governments that have bailed out so many of these failing institutions because of the credit crisis, ammunition to go after Goldman. And the state of Bavaria is no longer doing business with Goldman. It gives a lot of hobbled governments ammunition to go after what is the only scapegoat right now. And I'm not saying scapegoat is probably not the right word, but whether they're proven guilty or not, they're being forced to play defensive. And the reason why they've done so well through this credit crisis is because while all the big banks that have been imperiled by capital have been playing defensive, Goldman's playing offensive, gaining market share and whatnot.
But now they're on the defense.
Now they're on defense, and that costs business. There's no way of looking at that.
We don't know how much business it's going to cost them, because we also don't know who else is out there wanting to sue them.
Right. Right. Well, it just becomes easy. So I can tell you anecdotally, you see small competitors hanging around the rim, scratching their hooves, waiting to go after Goldman market share. And certainly while the market is disrupted and while they're distracted, which will be a year and a half end-on type of legal battle, they're going to lose market share and smaller players will gain market share.
So do I want to sell shares in Goldman Sachs as if I'm an investor right now?
I think Goldman's support is right at book value, so that's in the 120s, it's a good franchise. They're going to continue to do well. I mean, people never assume that they're going to make money if they make a low teens ROE, which is twice what the banks are making. That's still a pretty good return, but it's going to be very difficult for them to catch momentum. And since last summer, when the stock did so well, there hasn't been momentum around any of the businesses, and so I think the momentum has clearly been taken away from Goldman.
So you talked back in 2007, you were one of the few with a voice out there talking about the shortfall in capital. How would you characterize the capital in the banking system today? Is it well capitalized? Do they need to raise more capital? You don't have buy ratings on any of these banks. You only have buy ratings on Visa and MasterCard.
Right.
In all of the stocks you cover.
So capital is assets minus liabilities. And if the assets are marked correctly, then they're well capitalized. But if the assets are not marked correctly, then they're not well capitalized. And it all boils down to the boring issue of U.S. housing. So U.S. housing has stabilized, but that's because there's been so much property held from the market. So the issue of shadow inventory. I think during this quarter, the banks are going to start to test the market and put actual product on the market, and the prices will go down because there'll be more supply. Prices will go down. How much those prices go down and how then mismarked their assets are remains to be seen. A common theme at this conference has been, while there's been incredible asset inflation, there just hasn't been that much volume, actually, real volume to test the clearing prices. And then for housing, I'm a firm believer that we're going to have a double dip in housing. That will then question the asset values of carried on banks.
So you think you're going to be able to get all these banks at much better prices?
You have. I mean, look,
which means they're going down, is what you're saying.
It's going to be difficult to support these banks at these levels. Let me just point out the obvious. The regional banks that have highly broken business models have been the incredible performers this year, which makes zero sense.
You're talking about lots of consumer credit being down as well. You don't think the consumer's there?
No, there's no doubt about it. The corporation has recovered, so you have a bifurcation of the economy. The corporates have done well. Those that can access credit have done well. Small businesses and consumers, I use them interchangeably because they fund themselves the same way, credit cards and home equity loans. They're on their rears, and things have not gotten better, and you see credit continue to contract. So there is no revival on Main Street, and there's no revival for the consumer, and that gets worse.
Well, that was Meredith Whitney speaking earlier to CNBC's Maria Bartiromo. Slip into a break on your